Okay, we are going to today go over the first chapter, 10 Principles of Economics. So you should download and print out the skeleton copy of notes that are posted to the Moodle. Um, if you don't want to print those out, then you can just take notes as we go through this PowerPoint. So the 10 Principles of Economics. In this first chapter, we're looking at what kinds of questions does economics answer? What are the principles of how people make decisions? What are the principles of how people interact? And what are the principles of how the economy as a whole works? There are 10 principles of economics that we're going to go over. And one of the most fundamental principles in economics is that resources are scarce. Scarcity refers to the limited nature of the resources that we have available in our society. So we simply cannot get everything that we want. Economics studies this. How do we manage the fact that we have, in fact, scarce resources? So economists study a variety of things with regard to this principle. They study what people buy, how much to work, how much to save, and how much to spend. They study firms. Firms have to make decisions with how much to produce and how many workers they're going to hire. Society has to decide how to divide resources between national defense, consumer goods, protecting the environment, as well as other needs. Okay, there's a variety, again, 10 principles. I'm just going to put the first 4 up here, and then we're going to go right to principle 1. People face trade-offs. To get something that we like, we have to give up something to get something else. Going to a movie the night before an exam. That would leave you less time for studying. Having more money to buy stuff means you would have to work longer hours and thus have less time for leisure. Protecting the environment means resources that could be used to produce consumer goods or things that you and I may want instead are going to protecting the environment. Society faces trade-offs. The more as a society or the more our government decides to spend on national defense, guns to protect our shores, the less that can be spent on consumer goods, such as good old-fashioned butter to raise the standard of living at home. Pollution regulations, cleaner environment, and improved health, but at the cost of reducing the incomes of firms' owners, workers, and customers. Efficiency. Efficiency refers to society, how society gets the most from its scarce resources. So there's a trade-off between efficiency and then what's referred to as equality, or the prosperity, how prosperity is distributed uniformly among society's members. So what's the trade-off there? If you want more equality, you could redistribute income from the wealthy to the poor. But when you do that, this reduces the incentive to work and produce, thus shrinking the size of the economic pie. So how would you transfer wealth? Through our, what we call our progressive tax system. And we'll go into much greater detail in all of these principles throughout the course. Principle 2, the cost of something is what you give up to get it. Okay, so you have to make decisions comparing the costs with the benefits of the alternatives. You need to include something called our opportunity costs that we'll talk about in great detail in class. Opportunity costs, whatever must be given up to obtain some item. So the opportunity cost of going to college for a year. You have to pay for tuition, books, and fees, plus you're giving up a salary. How much is that money? How much could you have earned if you would have chosen to go to work instead of going to college, going to the movies, the price of the movie ticket, plus the value of the time you spend in the theater. In other words, what else would you be doing if you weren't sitting in the movie theater? Principle 3 refers to the fact that rational people think at the margin. So what's rational? Systematically and purposefully do the best they can do to achieve their objectives, given the available opportunities. Make decisions by evaluating costs and the benefits of marginal changes. Marginal changes means what are the small incremental adjustments to a plan of action. Examples: cell phone user with unlimited minutes. The minutes are free at the margin. If you have unlimited minutes, you're often prone to making long, frivolous calls. The marginal benefit of making that extra call if you have free minutes would be greater than 0. A manager considers whether to increase output. A manager would compare the cost of the needed labor and materials to the extra revenue that they're going to be able to earn from increasing their output. Incentives. People respond to incentives. An incentive is something that induces a person to act. So what's an example? When gas prices go up, consumers aren't going to buy gas-guzzling cars. They're going to buy more hybrids, SUVs, things like that. When cigarette taxes go up, teen smoking falls. Okay, let's next apply some of the principles here. Let's say that you own a 2007 Mustang. You've already spent $1,000 on repairs. At the last minute, the transmission dies, and you can pay $900 to have it repaired, or you can sell the car as is. In each of the scenarios that I'm going to give you here, I want you to explain what you would do. Would you have the transmission repaired if the Blue Book value, meaning what you could actually get for the car, is $7,500 if the transmission works and $6,200 if it doesn't work? The second scenario, would you have the transmission fixed if the Blue Book value is $6,300 if the transmission works and $5,500 if it does not work? So in other words, is it worth your time and your resources to get the car fixed? So let's take a look here. So think about that. You can pause the video and come back to the answers. So the cost of fixing the transmission is $900. The Blue Book value is $7,500 if the transmission works and $6,200 if it doesn't. Benefit of fixing the transmission then is $1,300. So the difference between the $7,500 and the $6,200. Get the transmission fixed. In this case, it would definitely be to your benefit to get the transmission fixed. If the Blue Book value is $6,300 if the transmission works and $5,500 if it doesn't work, the benefit of fixing the transmission is only $800. So you would not pay $900 to fix the transmission if the benefit that you're going to get is only $800.